Like I'm going faster. Exactly.
I'll show you they still buy it at school right now. Like 3 tests back to back, 50%, 56%, 52%. And I was like, I can't break.
Okay, we're ready to get started?
So if I get this test back.
Now, mutual funds. We're back here. I want to start with, what does family of funds mean? So I'm going to go to, let's see, slide 17. I get this to work. And the definition you see here says, family of funds exists when one investment company manages a group of mutual funds. Now, I want to make sure you realize what that means. The one I've been showing you in class, is my favorite, is the Fidelity no-load mutual fund company. And I went ahead and said, show me all the mutual funds that a customer, an individual could buy through Fidelity. Look how many there are. 10,921 mutual funds. But then I realized Fidelity has this situation where they have investors who may want to get into mutual funds outside of Fidelity. And so that's why there's so many. So you can narrow your list down by, first of all, I always click on no transaction fee fund, meaning no loads, nothing to get in, nothing to get out. Watch what happens to the number when I click that. Now we're down to 3,694 of them that don't have fees. These are the true no loads. Then I said, if I click on this box, Fidelity funds only, that's what family of funds mean. It means all of them that are within the family of Fidelity, in which the employees who are managing them work for Fidelity, and their names all have Fidelity in them. And now I'll click on that, and we take the list down to 326 no-load, no-fee mutual funds are part of Fidelity. Now there's an advantage to staying within the family. Even though you could have a Fidelity account and you can go ahead and buy mutual funds from other companies, but the advantage to only buying Fidelity's mutual fund, staying within the family, is when you go to transfer money in and out of mutual fund, it is so much faster and easier, and you don't have to worry about, oh, was there a fee because it was a different company type of thing. So I'm a big believer that if you set up an account at a no-load mutual fund company like T. Rowe Price or Vanguard or Fidelity, that invest in their family of funds that are managed within, and it makes life a lot easier. Because if you go and do a transfer from outside of Fidelity with your Fidelity account, there may be a limit on how many you can do and not get charged a fee, and all those different rules that exist, and you'd have to read all that. But when you stay within the family, usually the limits are waived as to how many. You go in and out several times. I mean, there's a limit, once per month maybe, or something like that, or 10 per year. But if you're going outside the family, sometimes the most you can do is 4 per year to avoid fees, because they're not even part of Fidelity, and they're just doing it for you. Fidelity has it all set up where if you have an account with them, you can even buy and sell individual shares of stocks of companies right there in Fidelity, even though they're a no-load mutual fund. And what's crazy is their fees are almost better than any discount brokerage out there. $4.95 to buy, $4.95 to sell. I mean, that's cheaper than our game. What are we, $7.99 or $6.99? $6.99, $7 in, $7 out. So, you see what a good deal. So I clicked on family of funds, which are Fidelity family. No transactions, got it down to 326 of them. If I start scrolling down, look at the names. They all start with Fidelity, because they're all in the family of funds. All right? Look at what some of these did. 52.54% in the last 12 months. That's unbelievable. Now, how do you make money off mutual funds? These are the 3 ways to make money, and a lot of students get these second one and third one confused with each other, so I want to make these clear. Dividends, capital gain distributions, and capital gains. Very different from capital gain distributions. Dividends, capital gain distributions, and capital gains are the 3 ways to make money off of mutual funds. So, if you're in a mutual fund through Fidelity, and the Fidelity mutual fund owns shares in, let's say, 50 different companies, and a few of those companies pay dividends, when it's time to pay dividends, they'll pay them to the mutual fund. The mutual fund then will take those dividends and start sending checks out to everybody who owns shares in the mutual fund. And all of a sudden you'll get a check in the mail, and it may be only for like $7. You go, what's this? And it will say dividend distribution. It distributed the dividends it received back out to the shareholders who own shares of the mutual fund. So that's how you can make some money, the dividend. Next, capital gain distribution. This is where the mutual fund manager, again, 50, 100 companies of shares, right, is almost every day buying and selling different shares. Well, if they bought it at one price, sold it at another price that's higher, that's a capital gain for the mutual fund. And part of that capital gain gets distributed to the people who own shares in the mutual fund. And then all of a sudden you'll get another check in the mail, and it will say capital gain distribution. And usually that check's a little bigger. Maybe it's $20, $30, $40, depending on how many shares you own, of course. So there's a second way to make money. But most of the money that's made on mutual funds is when you originally got into the shares of the mutual fund, and then you said, now I'm going to sell my shares in the mutual fund, and you're selling them for a higher price than you bought the mutual fund to get in. So for example, I'm just picking one at random, Select Software and Internet Technology Fund. Boy, that's pretty in only one area. 2,500 minimum to get in. Net asset value, we talked about last lecture, how that's the price at the end of the day. It's at the market's close, that's probably yesterday's price. Oh no, yeah, yesterday's price. So tomorrow you'll see this, it will say 221, it'll have a new, it's the net worth of the mutual fund divided by the number of shares. And so you bought in, let's say 2 years ago at $100. And maybe you bought 50 shares. There are 10 shares, not even that, 5 shares. It's only 2,500 to get in. So 2,500 divided by 177, however many shares that is. You bought it 3 years ago at $100 a share. And now you're ready to sell. You've gained $77.35 for every share you owned all that time. And when you sell it, say, hey, I'm handing these back in now, I'm ready to sell it. All you got to do is get online, you can sell it, you just transfer the money out, or you can call them and they'll send you a check, or they'll transfer it for you, and they charge you nothing. If you want it wired right away to your bank account, there may be a small $5 fee or something, but if you take a check or just have it put into your money market fund, like the savings account of the Fidelities, it costs you nothing. And that's called a capital gain. That's where most of the money is made in mutual funds. Is buying it for one price, hanging on to it for a while, selling it for a higher price. So dividends, capital gain distributions, but capital gains is where you bought it at a lower price and sold it at a higher price. Let me review capital gain distribution again. You're part of the mutual fund, and the person managing, the team managing the mutual fund, is buying and selling individual stocks, and they're making money off the buying and selling of individual stocks, called capital gains. Then they send checks out to the shareholders for part of that money they made to do what's called a capital gain distribution. Very different than you didn't have to buy or sell anything. You just got the check because you happened to be owning shares at the time in which the capital gain distribution was taking place. Yes?
Okay, so these money managers,
Yes.
they are actually making money off your money.
Kind of. They're making money for you off your money.
Are they making money for you?
For you.
They're not making any.
They're making money. They get paid a small salary, and then if they perform exceptionally well, they get this unbelievable bonus, usually at near the end of December. And that's really how they make their money. They're bonus driven, because it's all about that bonus in the financial world. You know, if they live in New York, and maybe, like I told you, my one friend was making $150,000 a year. Living in New York, that's like only making, $60,000 here. And then, but when December came and he outperformed the market, he'd get over $1 million in one transaction as a bonus.
Okay, can we take an example like Amazon, for example? Amazon, so like if
Amazon's not a mutual fund though, that's an individual stock. So if you're in this mutual fund and the mutual fund happens to own some shares of Amazon,
right,
and the mutual fund manager sold those shares of Amazon for a higher price than what was bought, that's a capital gain for the mutual fund. then they'll send checks out to shareholders. That's a capital gain distribution from the capital gain made by the manager.
Okay.
Your capital gain is when you decide to leave the mutual fund and you said, I'm out of there at a higher price, net asset value, than when you got in. That's the capital gain. That's where you make most of your money, right there. Now, there's a great example, by the way, on page 444 that I want to highlight, because this, what you're about to learn, this formula, calculating how much profit you made off a mutual fund investment, is probably the most important calculation from this chapter. And it is for sure on your next quiz and possibly your final, because out of this whole class, as far as investments concerned, most of you probably may only experience mutual funds in your whole life because you just may not be into investing. But you are forced to be into it because of your retirement program at the company you're going to be at eventually. And so you want to know how much money you made off the investment. And that's where this calculation comes in. You have to add up the dividends that were distributed to you while you owned the mutual fund. You have to add up the capital gain distributions, the checks that were sent to you. And then you got to figure out how much you made from how much you spent when you bought it and how much you got when you sold it. And that difference is the big gain called the capital gain. And you got to add that up. And there's all the money you made off it, those three things. In this case, let's see, what do we got here? I'm going to the second paragraph. For example, assume you had 100 shares of Majestic Growth Mutual Fund at $12.20 per share. And so 100 shares at $12.20, you spent $1,220 to get into that mutual fund. And how much time went by? 12 months later, it's just a coincidence, it's exactly a year, kind of makes the math easy. But exactly a year later, you received income dividends of 20 cents a share, capital gain distributions of 30 cents a share. So we got, there's the money we brought in, 20 cents times 100 shares. What's the other one? 30 cents times 100 shares. There's the second one. And then you could, let's assume you sold it at the end of these 12 months for $13.40. There's the big gain. $13.40 is what you sold it at. You bought it at $12.20. So is that $1.20 times 100 shares was the big money you made. So you made the dividends that got sent to you, you made that capital gain check that got sent to you, and now you sold your shares, and this is where you made the big money, and you got to add them all up. 100 shares times 20 cents, there's $20 for those dividend checks you received. 30 cents times 100 shares, here's your capital gain distribution checks you got, $30 worth for the year. And then you sold it for $1.20 more than you bought it for. That's $120. The 120 plus the 30 plus the 20 is $170 is the profit you made off this investment on this mutual fund. You got to take it a step farther. You got to divide the $170 by the initial amount of money you had to put up to get into this investment to figure out what your percent gain was. So 170 divided by 1,220. Remember, we bought in at $12.20 a share, 100 shares. So 1,220 is 0.139. You made 13.9% gain on everything that had to do with this investment. Your dividends, the checks you got, capital gain distribution checks you got, and the money you made by getting out of this mutual fund for a higher price than what you got in for. All of that added together was, now here's reality. You may have held this mutual fund for 2 years, not just 1 year. And you are being asked, what was your annual percent gain? Does everybody hear this? This is a big deal. This calculation, we're hypothetically pretending you had it for 2 years instead of 1 year. And the last part of the calculation is because you're going to be asked, what was your annual percent gain for 1 year? But you were in it for 2 years. So you would take that percent you calculated, 0.139, and divide it by the number of years you had it. So really, if this were a 2-year investment, it would be half of that. What is it, about just shy of 7% a year is what you average, with the dividends, the capital gain distributions, and the fact that you sold it for more than what you bought it for. So that's the last step I want to make sure you understand. You figure out all the profit, divide the profit by the amount of money it took for you to get into the investment, and then take that percentage divided by however many years you were in it. So let's say you were in it, I want to make sure you get this. Let's say you were in this 30 months. What are you dividing the last calculation? You got a percentage, but you're in it for 30 months, and the question says, what was your annual rate of return, meaning yearly?
2.5.
Because it's 2.5 years. 30 months is 2.5 years. You divide by 2.5 to get that per year. All right, so the last step is dividing by however many years. You got to convert 30 months into how many years is that? 2.5 years. 36 months, 3 years. All right, that's probably the most important part of today's lecture. So let's just go home and start vacation.
Yeah, good.
Yeah. When you walk out, I'll just finish the rest of the camera, and you can watch it later while you're on vacation. I was going to say somewhere on vacation, like Florida. Who knows where people go anymore? I don't know. When I was your age, I was in Florida driving my car on the beach in Daytona. And my friend and I were so out of money that we couldn't stay in a hotel, and we had to sleep in the car on the beach on the last night because we were out of money. We drank all our money. Right? Now, bond mutual funds. Whoops. Where am I at here? Back to this. I want to learn about some of the names of bond mutual funds. Well, Fidelity must have some bond mutual funds. But right now we're looking at a list of 326. How can I break it down just to see the bonds? Fidelity's website is so perfect. You can literally just go down here and click on, I want to see municipal bond mutual funds, and I want to see taxable, thank you. I want to see taxable mutual funds. So I clicked on municipal bonds and taxable bonds, so these would be the bonds. I still have no fees collected or checked, and I have Fidelity still checked, so this is within the family. Bonds that are municipal and corporate bonds. 68 of them. So you'd have 68 of them. By the way, there'll be at least 2 of these in the possible selection of mutual funds when you go to that company who says, okay, we have a retirement program, you have to select where you want your retirement to go to. There's going to be maybe 10 or 12 choices. At least 2 of those are going to be bonds just like you see here. Every company includes bond mutual funds, stock mutual funds, a mixture, a blend of each, and then they have that safe one, like a money market fund, where maybe it's only making 1% a year, but you never lose money. If you think the stock market's going to crash, take your retirement and put it in that safe zone and wait for it to crash and then move it back into the mutual fund. But anyway, here are the bond ones. These are all bonds. Remember when we talked about bonds in that previously, and we had to calculate to tell the difference between a municipal bond and a taxable corporate bond because one was not taxable? If a municipal bond mutual fund exists, all that's in it are municipal bonds, so it is non-taxable. You don't even have to be in the municipal bond to avoid the tax. You can be in a mutual fund that's in a whole bunch of municipal bonds, and you get to pay no taxes on it. So for example, I'm looking for one with the word municipal in it. Here's a tax-free bond fund. Muni. Muni means municipal. National, long-term bonds. How has it done the last 12 months? See, it hasn't done that great. Interest rates have been kind of going slightly up in the last 12 months, and bonds just don't. Look at how this bond mutual fund has done since January, just the month of January, because all of these numbers are based as of January 31st. They won't update until the next month ends. Losing money. A lot of bond funds lose money because when interest rates go up, when they're heading up, bond mutual funds in your retirement are what you want to be out of. And if we have some kind of financial crash and you go, wow, I bet they're going to stimulate the economy by lowering interest rates. If you feel the interest rates are going to be lower, you start seeing on the news, they may start lowering interest rates. You want to get to your retirement and start shifting your money into the bond mutual funds. Because if we could go back to 2009 and 2010 and 2011, these bond mutual funds on this list were probably outperforming every other mutual fund because interest rates were going down. So here are some of the names of them. And what's nice about these tabs up here is I always like to see how risky is this mutual fund. And you click on risk, takes everything on your list, the same 68 funds, and brings you a risk chart. This one is probably the lowest risk right here between what we can see on the screen here. And that's that municipal national long-term bond fund right here. This is an intermediate term bond, but this is not tax-free. We're going to see there's another municipal up here. These are all, when you see the name high yield, right up there, see high yield bond, high income fund, global high income fund, right there, high yield bond. That goes back. Again, where's our Moody's? Wait, you don't do that, it's on our PowerPoint. Where is this? Slide 14? Right there. Where is it? Right there it is. The word high yield in the name of the bond or in the description of the bond means it's a junk bond mutual fund. It is investing in those risky type bonds, trying to grab that higher rate of return, but it is taking a lot more risk. So they disguise the word junk bonds with the word high yield. So those up there that say high yield bond, the money managers are investing in junk bonds, which would be, I believe, if we look back at that Moody, it was BA or BAA and below. I think, wasn't the rating something like BA and below or something? All right, so real quick, here's some other names. Intermediate corporate bond. That means most of the bonds are going to mature between 5 and 10 years, and these are corporate bonds, so they're taxable. Intermediate U.S. bonds. This mutual fund's investing in treasury bonds, United States bonds that are going to mature in 5 to 10 years. Those notes. Long-term corporate bond. These would be like those 30-year and 20-year maturity corporate bonds that this mutual fund manager is buying for this mutual fund. Long-term U.S. bonds, that would be those 20 and 30-year U.S. Treasury bonds. There's municipal bonds. We just talked about those. They're tax-free. Short-term corporate bonds, short-term U.S. bonds. And those are it. Those are the names you would need to know, let's say, for a quiz, for example. High-yield bonds, intermediate corporate bonds. And now you know about bond mutual funds. Index funds. We're going to slide 11 for a second. Right here's a little description of it. This is kind of a different type of mutual fund. It's a mutual fund, just like all the other mutual funds. But the difference is that usually there's only not a team of managers, but just one manager. And usually this manager who's managing this index fund is managing some other funds because this is the easiest type of mutual fund to manage. How these index funds work is usually in the name, they'll put whatever it is they're mirroring. They are going to have the stocks or bonds inside of it that are inside of whatever it is that they're mirroring, that they're trying to duplicate. So if you have one that says Dow Index Fund, it's saying what companies make up the Dow Index number, and there's like only like 30 or 40 companies, and they'll say, and what percent of each company is making up that Dow Index number, and then it mirrors it and says, I'm going to buy this many shares, this many shares, this many shares of those same exact companies so that the mix is the same percentages. And then the manager just watches the Dow Index. And if that changes, and Dow Index sometimes says, we're no longer going to have blankety blank company part of the Dow, and we're bringing in this company. When that announcement happens, the manager of the mirrored index fund says, I'm selling these shares, I'm buying these shares, because it mirrors the index. And if you saw a graph, if the Dow goes up, this mutual fund goes up exactly like it. It just is right on top of it on a graph because it's mirroring it. S&P 500 index funds are mirroring the S&P 500. It will have shares of all 500 companies that are making up the S&P 500. The Russell, whatever, 300, it will mirror that. All these index funds are just mirroring something. So if we go to Fidelity and go, wow, what about an index fund? I want to show you the advantage of an index fund. So I got to go down here to classification. You got to remember how to find index fund. No, I can't remember. Anybody see it? Ooh, there's money market funds out here. get rid of the bond funds. I do not see an index fund choice there as to a type. But you could just click on it and bring up index funds. Maybe you have to bring them all up. Real quick, I want to show you these money market funds since we're going to skip index funds. Usually you see the name of whatever it mirrors in it. These money market funds that you're looking at right now, how many are on there? 86 of them within Fidelity. These are like the savings account I was talking about. This is your safe haven. They have names like, what is this? Fidelity funds only, no fees, money market. I still got taxable bond down there. That's why I can see some names that shouldn't be there. There we go. Let me unclick that. Now let's see how many. 40 of them. And they're all money market. Prime money market, money market, money market tax, money market. And they usually have the name money market within their name somewhat. Money market, money market. That's the name of their savings account. It would be the equivalent of. Very safe. Doesn't make a lot of money. Let's get the performance overview here. In the last 12 months, look at what they've been doing. A little less than 1%, 1.06%, 1.12%. Now, some of these are like for full retirement programs, so it takes like $1 million to get into them. So I'm going to go down here, and I'm going to go, where is the expenses, returns, there's somewhere. You can click on it to say, hey, what if I only want to invest, want to get into one that I can invest in? Let's see. Whoops. Income characteristics. Here we go. Average duration, average maturity, last dividend. No. Somewhere on here you can go ahead and put how much. There we go. Minimum investment. I'm going to move that down to something more realistic. Let's say it only takes $5,000. No, let's go down to $2,500 to get in. Look at the list now. There's 6 of them. If all you want is one that takes as little as $2,500 to get in, to open your account, this would be where you start. Send them to, when you got $2,500, you send it here, and you say, I'm putting in one of these funds. And then you just start doing research, and when you're ready to switch over to one of the other mutual funds to make some real money, your money's right there. You have an account set up now. You just go click, click. And because it's mutual funds, you got to wait till the end of the day, and whatever the price, net asset value of that mutual fund you're going into at the end of the day, it transfers over, and all of a sudden you'll see now how many shares you have of that mutual fund. And when you go, oh my gosh, I want to get out of this mutual fund, click, click. You're going back into one of these 6 money market funds then, where it's safe, where there's no way to lose money. And you're only making 0.5% a year, 0.62, 0.93, almost 1% in the last 12 months. But you're never losing money. That's what these are about. They're like a savings account. They're the safest thing that a no-load mutual fund company can offer customers. They're not insured. At the bank, when you put your money in the savings account, it's insured by the U.S. government. If that bank all of a sudden, goes out of business, you're going to get your money back. The U.S. government's going to make sure of it, and they're going to send you a check and the interest that accumulated at that point. These are not insured. I mean, don't get me wrong. Fidelity manages trillions of dollars, not just billions. They're probably into the trillion, and so it's fairly a safe company. I mean, the whole economy would have to collapse for you to lose your money, for Fidelity to go out of business. And it's possible. But it's just, if that happens, the odds of the government having the money to pay you back in the savings account, so it's almost the same thing. So, how do we feel? We understand? I just wish I could have found that little box for index funds so you could see some of the names of them. There's the names like a Dow of an index, of S&P 500 or Russell. And what they have are very low expense ratios. So do, by the way, so do money market funds. Look at the expense ratio. Do you remember what our target was? What do we compare the expense ratio to? What was the percent of expense ratio we compare these to? I said I never would get into a mutual fund that had an expense ratio above what? 1%. And the ones we were looking at were 0.79, 0.78 of almost 3/4 of 1%. These are not even a half of 1%, because these money market funds are hardly take anything to manage, and this is what you would see with index funds. They're also less than a 0.5% because there's hardly any managing that has to take place. If the index is making a change, the manager makes the exact same change. They don't have to sit there and watch prices of stocks all day long. And that's why the expense ratio is so low on index funds and money market funds. Most of the money is going to the investors. All right, how are we doing? Exchange traded funds, they're different. We're going to slide 5 on the PowerPoint. This is different. They're kind of like index funds in a way, but what's different about these is you just can't get a hold of Fidelity and go click, click, I want in this index fund or in this exchange traded fund. With an index fund, you just go click, click, you're in the index fund, a bond fund, a stock fund. Electronically traded funds are very different. They're kind of like stocks. The prices are changing on these every second. And you get the price just like a stock anytime during the day. You don't have to wait for net asset value. That there's only so many of these shares out there, and somebody has to be selling the share, and then a buyer, and they connect, and that's the price, right then and there. So that's the difference between these mutual funds and all the others, is that they're kind of like stock, and that the price is going up and down all the time, and you can get it right then. You don't have to wait till the end of the day. Closed-end funds, this is where a mutual fund manager says, hey, when this mutual fund reaches $10 million, it's closed to new investors. And when that happens, the only way you can get into that mutual fund is when somebody who's in it already is selling their shares. And that's how a closed-end mutual fund works. And sometimes those perform better than others only because they're so hard to get into, because you're waiting for somebody else to want to get out for you to get in. So it's not necessarily always based on just net asset value on that one either. But all the other ones are net asset value, the net worth of the mutual fund divided by the number of shares. Closed-end funds, exchange traded funds are what we just talked about. And last, I'm going to slide 26. Taxes. Taxes. You got this dividend check in the mail from the mutual fund you're in. You got this capital gain distribution check in the mail. And you may have sold some shares in mutual fund. All of this money, if it's not a municipal mutual fund, are taxable. All of it. Dividend check, the capital gain distribution check, and the fact that you made money by buying it at a lower price and selling it at a higher. All taxable. But there's two types of taxes. You can either be taxed what's called a short-term capital gain tax or a long-term capital gain tax. The long-term tax is much lower than the short-term tax. And here's the difference. If you're somebody who gets into a mutual fund, and maybe you got a dividend check, and maybe you got a capital gain distribution check, and then you sold to get back out of that mutual fund, and the time you bought and sold was less than 1 year. Let me say that again, was less than 1 year. You have to pay full taxes on that money, just like it's income, whatever tax bracket you're in with your income. Full taxes. But if you held on to the investment, the part that's capital gain from buying and selling it, the biggest part of the money you make off it, longer than a year, you get a discount tax. Significant discount tax. Usually about 10 to 15% less in taxes you have to pay than you do on your income. You get a discount because you held on to it for longer than a year. Long-term and capital gain tax calculations are all based on a year. You know how you get a W-2 in the mail, right? When you, at the end, January or February of the next year, because the year's over and you've been working at a job, you get something just like a W-2 from the mutual fund company. And you'll get one that whether you sold your mutual fund or not, because you probably got some dividend checks and some capital gain distribution checks, and those are taxable. But the part where you bought into the mutual fund and sold it, that will also be on that W-2 looking thing. It's called a 1099, but it looks like a W-2. And that part on there will have a word next to it that says either short-term or long-term. If the word short-term's on there, you have to put it on the tax form where it says short-term investments, and you're paying full tax on it. If the word long-term's next to it, it means you held on to it for longer than a year. You get to put it in another form. A calculation gets done that lowers the amount you have to report, which ends up allowing you to pay far less taxes on it, usually 10 to 15% less taxes on it than you would normally. And then the number at the end of that form goes back on to your 1040 form, your tax form, and you're not paying taxes on the whole thing because you got this huge discount because you held on to it for longer than a year. And if you ever get to a situation where you're going, oh, I need some money, I'm going to have to sell some of my investments, this is a big deal to say, I'm not going to sell any of the ones I haven't had for a year yet. Because to pay that extra 10 to 15% in taxes doesn't make sense to sell those compared to selling one that you've held for over a year. You want to focus on, if you have to sell an investment, you want to sell one that you've had for over a year. Only look at those to decide which one to sell. Because you're paying such a lower tax on them, there's a huge benefit. You'll come out way ahead by selling one of those instead of the ones you just bought recently because of that tax savings. So that's the big deal. You ready for the in-class?